Last night, President Trump announced tariffs against dozens of nations, far greater than many investors expected. And markets are reacting accordingly this morning, down about 3 to 4% in the US equities. Now, investors heading into this event, which was called Liberation Day, expected there to be pretty much a resolution of the trade war that has been escalating for the last few months. But what we got was anything but resolution. It seems like we're closer to the beginning than the end. And that's negative for markets because markets don't love uncertainty. If you think about what markets have been concerned about, tariffs and trade wars generally are very inflationary. They increase the cost of goods for both businesses and consumers. And as a result, people tend to spend less. Businesses tend to plan and invest less. And that weighs on economic growth. So when you have concerns about tariffs driving inflation up and economic growth down, we're entering a potentially stagflationary environment and with all likelihood, more of an economic recession. Now, recession odds in the prediction markets were closer to 10% at the beginning of this year. They've slowly started to creep up to basically 50%. In other words, the market's saying it's a coin toss whether we hit a recession this year or not. Now, as you know, what we've been doing behind the scenes is we've been cutting net exposure in our equity strategies over the last few months because we've anticipated what happened yesterday. We anticipated that markets had been too sanguine in their expectations, had been pricing in too much optimism. And if you look at the S&P valuation multiple and earnings estimates, both seem to price in a lot of good news and not much negative news. So as we think about the path forward, we think we're closer to the beginning than we are the end of this trade war escalating. We do expect more retaliatory tariffs from other nations. Whether we dip into a recession or narrowly avoid one, time will only tell. But as ever, it's important to stay nimble and stay active, and that's what you pay us for. So we're going to continue to monitor the data and act accordingly. For folks playing along at home, it's a good time to, one, make sure your cash is earning the highest yield it can be during this period of volatility. We think our smart treasury product can be great to that end. And it's also worth considering how you might be dollar cost averaging from that cash product into the markets as this volatility continues. We're going to look back, we think, in 3, 5, 10 years from now, and this is going to have been a great opportunity for long-term investors to take advantage and buy into markets. But by no means is this a go all in, buy the dip opportunity if you're near short-term focused. Because as we said, we expect this volatility to continue. We're closer to the beginning, but as ever, we believe the long-term equity market trend will be higher.